If you are sitting there right now, either already enjoying your retirement or standing on the threshold of leaving the workforce, I know what is keeping you up at night. You look at the news, you look at inflation, you look at the wild swings in the stock market, and you start asking yourself, is the money I worked 40 years to save actually safe? Are my paper investments going to purchase tomorrow what they purchased today? That fear is completely normal, but fear is not a plan. Action is a plan. So today, we are going to talk about something you hear advertised everywhere, a Gold IRA. But I don't want you buying into hype or slick commercials. I want you to understand exactly what makes a Gold IRA different from every other retirement account sitting in your portfolio, because if you do not understand the rules, you can make mistakes that cost you tens of thousands of dollars in taxes and penalties. First, let us get clear on what a Gold IRA actually is. A standard traditional or Roth IRA usually holds paper assets, stocks, bonds, mutual funds, ETFs. When you open a Gold IRA, which is a specialized self-directed IRA, you are buying actual, physical, tangible gold bullion and coins. Not paper promises. Not stock in a gold mining company. Real metal. Why does that difference matter so much to someone in their 60s or 70s? Because physical gold has historically served as a hedge against inflation and dollar devaluation. When paper currency loses purchasing power, gold has traditionally held its intrinsic value over centuries. For someone who no longer has 20 years to recover from a massive stock market crash, that element of balance and protection can offer incredible peace of mind. But listen to me very, very closely. This is where so many people get hurt because they do not listen to the laws. You cannot buy gold coins, toss them into a safe in your closet or under your mattress, and call it a Gold IRA. If you do that, or if you attempt a so-called home storage IRA trap that shady companies pitch online, the IRS will treat every single dollar of that gold as a taxable distribution. If you are under 59.5, you will pay a 10% penalty on top of ordinary income taxes, and even if you are over 59.5, you will face a massive tax bill that ruins your retirement savings. By federal law, the physical gold inside your Gold IRA must be held by an IRS-approved custodian and stored in a secure, audited IRS-approved depository facility. You choose what gold to buy, but the custodian executes the trade and ships the physical bars or coins directly to high-security vaults. Another critical difference is purity. You cannot just put old jewelry or collectible coins into this account. The IRS demands strictly defined purity standards. Gold must be 99.5% pure bullion. American Gold Eagles, Canadian Maple Leafs, and certified investment bars qualify. Rare or numismatic collectible coins with huge markups do not qualify, and scammers love pushing high-commission collectibles on unsuspecting retirees. Do not fall for it. Now, let us talk about how you fund it, because this is where the real actionable strategy comes in. Most retirees do not fund a Gold IRA with fresh cash out of their checking account. Instead, you perform a direct custodian-to-custodian transfer or direct rollover from an existing traditional IRA or former employer 401k. Notice I said direct. In a direct transfer, the money moves straight from your old financial institution to your new Gold IRA custodian. You never touch the money. The check is never made out to you. That means zero tax withholding, zero taxable event, and zero risk of missing the strict 60-day rollover window that would otherwise trigger heavy IRS tax consequences. And what about fees? This is another key difference you must understand. A traditional brokerage account often lets you trade stocks for zero commissions. A Gold IRA has real-world physical costs attached to it: setup fees, annual custodian administration fees, insured depository storage fees, and buying or selling spreads on physical metal. You must factor these ongoing costs into your decision. Gold does not pay a quarterly dividend, and it does not pay interest. It is a store of value and a risk management asset, not an income generator. So, what is your takeaway? Gold should never be your entire retirement portfolio. Do not panic and move all your nest egg into precious metals. A sound, defensive rule of thumb for retirees looking for diversification is generally 5 to 10% of your overall portfolio allocated toward gold. It acts as your financial insurance policy, an anchor in the storm, while the rest of your assets continue providing growth and income. Be smart with your money, ask the tough questions, stand in your truth, and safeguard your hard-earned financial future.